Think about this for a second. You're selling a product for literally 5 times what it costs to make. That is an 80% gross margin. You should be rolling in cash, right? Well, welcome to The Explainer. Today we're looking at India's booming D2C beauty market, where over 1,000 brands are boasting those exact eye-watering margins, and yet almost all of them are bleeding money. It's a massive contradiction, and we're going to figure out exactly why. So what's the deal? Why do 80% margin beauty brands fail so spectacularly? Now, if you've been following the business space, you've seen the headlines. Year 1, year 2, these startups put up insane, explosive sales growth. It looks like an absolute gold rush. But honestly, that initial hype is mostly a mirage. The underlying foundation of this whole ecosystem is completely cracked, and it just breaks under the pressure of scaling. Let's look at the numbers, because the harsh reality is hiding right there in plain sight. Take a giant like Mama Earth. In year 2, they posted a mind-blowing 547% growth. Absolutely incredible. But watch the trajectory here. By year 4, that growth drops to 100%. Still solid, sure. But by year 7, it crashes down to just 7%. And they're definitely not alone in this. Brands like Sugar have seen the exact same pattern, some even hitting negative growth. It starts fast, and then bam, they hit a brick wall. Which brings us to our first major issue. The Me Too product problem. See, the great D2C illusion sells us on these unique, revolutionary formulations. Brand new science. But the reality on the ground? There are roughly just 8 to 10 major contract manufacturers in India, literally making the exact same products for everyone. Whether a brand is pushing a trendy onion hair oil or a vitamin C serum, it is usually the exact same base formula from the exact same factory. They just slap a different aesthetic label on the bottle. When everyone sells the exact same thing, you've got zero differentiation. A new ingredient trends, everyone copies it in 3 months, and customers just bounce around because there's no unique reason to stay. Let's move to part 2, harsh Indian market realities. We have to talk about this number right here, 15%. That is the total online sales penetration for the Indian retail beauty market. Just 15%. That means a massive 85% of all sales are still happening offline, in physical stores. Now, a lot of these D2C founders are super tech savvy. They built their initial hype with a laptop and some clever digital ads, but to actually scale, they're forced to step into the ruthless offline world. Suddenly, they're dealing with physical rent, distributors, retail margins, and extending credit. It's a totally different ballgame, and without that offline experience, many of these startups completely stall out. And the reality check gets even harsher when you look at the consumer's wallet. In the US, the average annual beauty spend per capita is a huge $313. In China, it's $76. India, it's just $28 a year. Let's put that in perspective. That's about 2,500 rupees a year, or roughly 200 rupees a month. The overall pie is shockingly small. There literally just isn't enough consumer cash going around to support 1,000 different brands all trying to become the next unicorn. Break that market down further, and the trap becomes incredibly obvious. 80% of it is the mass market, people buying highly affordable daily staples. Legacy giants like HUL and Dabur completely own this space with their massive offline distribution networks. Then you've got the 5% premium tier, securely held by trusted foreign luxury brands. So where do our 1,000-plus D2C startups go? They are left brutally fighting over this tiny 15% sliver of aspirational buyers right in the middle. It is a hyper-crowded bloodbath. Okay, part 3, the cost of discount loyalty. Let's look at exactly where all that margin cash is burning. Welcome to what we can call the CAC death spiral, customer acquisition cost. Here's how it works. A brand spends, say, 1,000 rupees on performance marketing to acquire one single customer. That customer buys a 1,000 rupee face wash. Now, thanks to that high 80% margin, the gross profit is 600 rupees. But wait a second. You just spent 1,000 to get them and only made 600 back. You are literally losing 400 rupees on that very first purchase. The only way this math ever works out is if that customer comes back again and again without you paying for more ads. Repeat buyers are absolutely crucial here. But here is the fatal flaw in that whole plan. Indian consumers don't really have brand loyalty. They have discount loyalty. We are incredibly smart, value-driven shoppers. Why would you stay loyal to brand A's face wash when brand B is suddenly offering a flat 50% off? Consumers will use multiple accounts, wait for the big festival sales, and just relentlessly hunt for the best deal. And since we already know the products are practically identical anyway, there's no real reason to stick around. So those vital repeat purchases never happen.
unless the brand bleeds even more money on heavier discounts.
And it actually gets worse when you look at how we naturally shop. Think of the fragmented bathroom cabinet. Go check your own bathroom later. I bet you've got a soap from one brand, shampoo from a second, and a face wash from a completely different one. Nobody buys a full routine from a single brand. We just buy the hero product. This means a company might spend a fortune manufacturing and storing 20 different products, but only one of them actually sells. They're absorbing the massive cost of 19 dead items just to move that one hero product.
So Section 4, the formula for profitability. How do you actually survive this?
Let's look at the actual math you need to make this work. The gap between what brands are doing and what they need to do is alarming. To survive, your average order value needs to be over 1,200 rupees. Right now, the industry average is stuck around 500. Your repeat rate? It has to be higher than 35%. Currently, most are hovering in the 15 to 20% range. And your true, fully loaded margin needs to stay safely above 60%. But after all those aggressive discounts we talked about, it usually sits at 40 to 50%. The math simply is not mathing for the vast majority of these companies. So what is the real path to scale? Well, the failing strategy is obvious now. Rely on contract manufacturing, burn cash on influencer hype, and get trapped in a never-ending discount loop. The winning strategy is the exact opposite. You need your own manufacturing to actually control costs and quality. You need real, unique innovation in your formulas, and you need strong community trust so people actually come back without needing a promo code. Look at a brand like Minimalist. They did exactly this. They built their own manufacturing, innovated with real science-backed formulas, built huge trust, and successfully sold a massive stake to Hool at a 3,000 crore valuation. It is totally possible. It's just incredibly hard. And that wraps up our explainer for today. It is wild to see how massive margins on paper can still lead to such heavy losses in the real world. But now I want to hear from you. What's your take on the Indian D2C scene right now? Do you catch yourself showing that discount loyalty when you shop online? Drop a comment below, let's get a discussion going. Don't forget to hit subscribe, and if you want to know exactly how Minimalist pulled off that 3,000 crore valuation, click on the screen right now to watch our full deep dive on them next. Thanks so much for hanging out with me, and I'll see you in the next one.